This content is for educational purposes only and is not financial advice. Consult a qualified advisor before investing. Welcome back to Understanding Money. Today we're taking a comprehensive look at the stock market, what it is, how it works, and exactly what you need to know to make your first trade with confidence. By the end of this video, you'll understand shares and exchanges, learn how to research companies, place different order types, manage risk, and develop a strategy tailored to your goals. If you're ready to demystify the market, hit like, drop a comment with your biggest stock question, and subscribe for weekly tutorials. Let's kick off with the fundamentals. The stock market is simply a venue where investors buy and sell ownership stakes, known as shares, in publicly traded companies. Picture it like an online marketplace. Instead of shopping for goods, you're buying pieces of businesses like Apple, Tesla, or Amazon. These transactions occur on stock exchanges, regulated platforms such as the New York Stock Exchange, Nasdaq, and international exchanges like the London Stock Exchange, that match buyers and sellers using sophisticated electronic systems or traditional trading floors. There are two main stages in a company's stock journey. First, the primary market, when a private company decides to go public through an initial public offering, or IPO, it sells new shares directly to investors to raise capital. This influx of cash helps the company expand facilities, fund research, or enter new markets. Once that IPO is complete, the company's shares trade on the secondary market, what we usually call the stock market, where all subsequent buying and selling takes place between investors. The company itself doesn't receive any money from these secondary trades, but its market capitalization, share price multiplied by the total number of shares, fluctuates based on investor demand and business performance. Why do people invest in the stock market? Primarily for three reasons: capital appreciation, dividend income, and portfolio diversification. Capital appreciation occurs when the price of a stock rises above your purchase price. For instance, if you buy one share of a company at $50 and it climbs to $75, you've made a 50% gain on your investment. Dividends are periodic cash payments companies distribute from their profits. Blue-chip firms like Coca-Cola and Johnson & Johnson have paid dividends for decades, providing steady income streams. Diversification, meanwhile, reduces risk by spreading investments across multiple companies, sectors, and asset classes so that a poor performer has less impact on your overall portfolio. Before you place your first trade, let's break down some essential terminology you'll encounter. A ticker symbol is a unique shorthand, for example, AAPL for Apple or TSLA for Tesla, used to identify each stock on an exchange. Market orders execute immediately at the best available price, while limit orders allow you to specify the exact price at which you want to buy or sell. If you need assurance on price but can wait, a limit order is your tool. You'll also hear about stop orders, which trigger market or limit orders once a stock reaches a predetermined price, useful for locking in profits or cutting losses. Bull markets describe sustained periods of rising prices, and bear markets are when prices fall by 20% or more from recent highs. Lastly, an index like the S&P 500, which tracks 500 large US companies, serves as a barometer for overall market health. Now, how do you actually start investing? Step 1 is choosing a brokerage. Research platforms based on fees, account minimums, trading tools, educational resources, and customer support. Well-known options include Fidelity, Charles Schwab, Trade Republic, and Robinhood. Once you've opened your account and completed identity verification, link your bank via ACH or wire transfer. Many brokerages now allow fractional shares, meaning you can invest as little as $1 in expensive stocks. Step 2 is research. Don't chase headlines or hot tips. Begin with fundamental analysis by examining a company's financial statements, income statement, balance sheet, and cash flow statement. Key metrics include revenue growth, profit margins, return on equity, and debt-to-equity ratio. For example, a company with steadily increasing revenue and low debt may be more resilient during economic downturns. Complement this with qualitative research. Read quarterly earnings call transcripts to gauge management's vision, follow industry news for regulatory changes, and consider competitive positioning and barriers to entry. Step 3 is placing your order. Suppose you decide to invest in ETF XYZ to gain broad market exposure. You choose a limit order at $100 per share because current ask prices fluctuate. Enter the ticker, your desired share quantity or dollar amount. Select Limit, set $100, and hit Submit. Your order will only execute if the price meets your limit, protecting you from unexpected price spikes. As your positions build, understanding risk management is crucial. Stocks can be volatile. News events, economic data, and even social media sentiment can cause dramatic price swings. To mitigate this, diversify across sectors, technology, healthcare, consumer goods, and even geographies through international ETFs. Use dollar cost averaging by investing a fixed amount on a regular schedule, say $50 every month. So you buy more shares when prices are low and fewer when they're high. Consider setting stop-loss orders to automatically sell a stock if it drops by a certain percentage, capping potential losses. Let's discuss two popular strategies: long-term buy and hold and short-term trading. A buy and hold investor selects fundamentally strong companies or diversified ETFs and holds them for years or decades, benefiting from compound growth and dividend reinvestment. Historical data shows the S&P 500 has returned around 10% annually over the past century, illustrating the power of long-term investing. Short-term trading, on the other hand, aims to profit from daily or weekly price movements using technical analysis, chart patterns, moving averages, and momentum indicators. While trading can offer higher returns, it demands significant time, discipline, and risk tolerance. We also need to consider psychological biases. Avoid pitfalls like fear of missing out, buying into hype at market peaks, and loss aversion, where the pain of losses outweighs the pleasure of gains, leading to panic selling. Maintain a rational mindset. Stick to your plan, review performance periodically. Quarterly is a good cadence, and adjust only when fundamental conditions change. As your confidence grows, you might explore advanced topics. Sector rotation involves shifting capital between sectors based on economic cycles. Covered calls can generate income by selling call options on stocks you own. And dividend reinvestment plans, DRIPs, automatically reinvest cash dividends into more shares, accelerating compounding. Before we wrap up, a quick note on taxes and compliance. In many countries, capital gains tax applies when you sell profitable investments. Rates vary by holding period. Short-term rates often match ordinary income taxes, while long-term gains enjoy lower rates. Keep records of all trades for accurate reporting. And remember, I'm not a licensed financial advisor. This video is for educational purposes only. Always consult with a qualified professional before making investment decisions. That covers our in-depth guide to the stock market. If you found this tutorial valuable, please tap the like button, share your top stock pick or question in the comments, and subscribe to Understanding Money so you never miss an episode. Thanks for watching, and see you in the next video.